test. Hello. Hello. Good morning, all participants. We'll be starting the webinar in another few minutes. We're waiting for more attendees to join in. Thank you.
Hello everyone, checking the sound. Can you guys hear me? So we'll get started now. Um, the In your window, you must have a place where you can see the chat. That's the best place to type the questions. And while we are doing the session, you can keep typing your questions. Or if I'm asking the question, you can use that window to answer the questions as well. So can few of you, or one or two of you, can actually type something there so that I know that you can hear me. Can you hear me? Great. We'll get started now. So, good morning and good afternoon, based on where you are, which part of the world you are in. Today's session will talk about how we use analytics within risk space, some of the concepts within risk, and how we can apply data-based analytics in risk area and to calculate the risk better to make better decisions. Also, we have tried to keep the things at a little bit higher level. But if you have any questions, feel free to type it in, and we will be able to answer those questions either during the course of the presentation, or even um, while in the end we will have some time for the questions. A little bit about me. So my name is Nilesh Singh, and I head up the model validation team, model validation as well as operational risk team in Australia New Zealand Bank. If I look at my core expertise, I would divide into three parts: analytics, or as we call it, data science these days. So mainly covering both the risk side as well as the marketing side, the campaign and market research side. Then around the risk management, so I worked and I have set up number of teams in ANZ and the prior organization working across risk areas. So regulatory risk, credit risk, market risk, operational risk, compliance side, and model validation, which is my new, current function now. And of course, some bit of work around the project management and leadership, which involves most of my time these days. This involves sponsoring projects, working on the projects, building up teams, setting up functions, doing transitions, etc. If you want to connect me on LinkedIn, you can easily find me by my name. Okay, so some basics to start with. What is banking? So anybody wants to answer that question? What is really banking? What do banks really do in the economy? And like I said, use the chat window to type your questions in, and I will be able to answer it while I'm speaking. As well as if I'm asking something, you can use that same window to answer those questions. So anybody who, what is banking? Okay, okay, few answers have come in. Okay, so banking is nothing but a way of transacting the money, as somebody has said. In some cases, what banks really do is that they take money from one party and give it to another party. They take it at the lower rate of interest and give it at a higher rate of interest. Example, so they will take it from the depositors or investors to an extent. And you would, if you go, you take the fixed deposit, current fixed deposit must be around 7-8%. And if you go and take the loan, either a home loan or the personal loan, you will find that the rate of interest of personal loan and the home loan is always higher than the deposit rates, because that's where the bank make money. So essentially, banking is way of value adding and taking the money from one corner to another. Bank also ensures that when the person comes in, there is he's pays the deposit, he's given the services. Similarly, when when the people come back and pay their EMI, there is a service provided to them as well. So what is risk? So this is in very general context, and to give you a bit of hint here, there are two components of risk. Risk is always defined by two components. So pausing for a few seconds if once people want to respond to what is risk really. Okay. Okay, so when we talk about the risk, we are not talking about the upside of the risk. We are always talking about that something that can go wrong, something which stops us from achieving something, or the two pieces that actually define risk are likelihood of something happening and consequence of it. So just in a simple manner, what is the chance that something can happen, and um, what if that happens really, then what is the consequence of it? So risk is a chance of something happening that will impact our objectives. That's the definition. And like I said, there are two measures, and we will see this measure in the context of the banking risk as well in a little while. Before we go, just another two terminologies. So what is control? Control is a kind of a process, policy, device, practice, or any other action which is used to minimize the risk or enhance the positive opportunities. Mostly, when we look at it, it is about minimizing the risk, and of course, when the risk is minimized, the opportunities get enhanced as well. So you can, and we'll take an example in a short while, but you can imagine that any kind of system that you're using, any process you're using, which tend to reduce the risk. Either it could be form of as extreme as insurance, or as simple as doing some bit of documentation about things. It is called control. Risk appetite. Different people have different kind of risk appetite. It is a level of risk one can undertake. So to give you a very good example, there are people at our individual level as well who are very high risk taker. They will go and invest in stock market, or even go invest in much higher instruments like probably Bitcoin or cryptocurrencies, or even much riskier instruments. But there are people who have very low appetite of risk, so they would not go beyond the fixed deposits, or even go, they may sometimes not even go for the fixed deposit. They will just prefer to keep the cash with themselves. So different people have a risk appetite. Similarly, organizations also have the risk appetite. Even business unit within the organization have the risk appetite, and that helps us to define that what level of risk an organization can take, or what level of risk a particular business unit is allowed to take within the organization, right? Let's take one example: risk of flying. So what is the risk of flying? I mean, what can possibly happen if we are taking an aeroplane to go from one place to another? Again, pausing for a few seconds to answer that question. Use your chat window to send the message. So yes, that's true. Okay, so risk of flying, so when you go from one place to another, you have number of options, but sometimes you take aeroplane, right? And the reason is that you want to reach there faster, but at the same time, or there could be convenience and other factors, but there is a risk that you're taking. When we take an aeroplane, obviously somebody said that there's a possibility of accident, right? Now let's think about probably two types of risk, right? There are many risks when we do anything, but let's take two types of risk. One could be the accident, and the second is that you reach late, right? um, so in the case of accident, what is the probability that it will happen, right? So you can say that it's a very low probability. And what is the consequence if that happens? If the accident happens, then probably you may die, or you may have a severe injuries. Similarly, the other type of risk that we took, which is reaching late. So what's the chance that the flights would be late? I think these days we can fairly say that, yeah, flights are generally late. So the frequency of those incidents is very high. Similarly, if you see the consequence of it, so then you can think about that. Okay, I may reach to my meeting late, I may reach to my interview late, or I may reach to a client place late, or relatives place late, some or the other. So which you would say that, okay, how do I minimize these things, and how what kind of controls we can put? So we took two incidents here, and I'll just go to the next slide. One where the severity is very high, but the probability is low, right? Probability is so low that we can think about still taking an aeroplane, even if the severity is of losing the life. Similarly, if reaching late is the type of risk, then the probability is very high, but severity is low, right? Because we can plan it better, we can start a little early, we can keep some buffers, we can apologize and say that the meeting can happen again next time, but it's not that difficult. What controls we can put? So now you start thinking about what kind of control that exists within if there's a risk of accident. And we can think about, there are a number of things that when we go into the flight, they say that you have to have, you read the safety procedures. You have if you land up into the water, you have the jackets. The various safety instruments that are installed in the aircraft. Similarly, for reaching late, I guess, like I said, you can plan your own controls. So again, as simple as the risk of flying, there are two types of we saw how we measure the risk. There could be number of risks. We have taken just two risk example, and we have measured it against severity and probability, right? If there are any questions, feel free to put it on the chat. Think about the example of the what kind of risk that exists in the banking or financial industry. So if we look at risk, we can broadly categorize into two parts. One is a financial risk and another is a non-financial risk. So let's talk about the financial risk first. So financial risk is something which arises because you're dealing with money, right? Your asset has some value, and the value of that asset can go up or down. So credit risk. Anybody who what is credit risk? Okay, so the risk that a person that whom you have given the money, the person who has borrowed the money from you, it doesn't repay it back, right? That's called credit risk. And though it's as simple as that, because we don't do only lending to individuals, we do lending to organizations as well. So it applies to the large organizations also, that they may decide not to give the money back to us, or they may be in a situation that they don't pay it back. But when we measure credit risk, one of the things which we can do is to look at how we can, for individual products that we have, for example, for the home loans or mortgages, or we have the personal loans, what is the different types of how we can, what we can do so that we can measure the credit worthiness of the customer. And we have one example of that in the coming slides. But let's take, so we spoke about the borrower's risk or a counterparty credit risk. We have the industry risk as well. So just think it an example that if we have to invest today, or if we have to give the money to the to industries, and that industry may be not at the right stage. For example, if there are a set of people who are working in telecom, right? And if there is a new telecom company which comes to a bank and asks for the money, then you would think that, okay, is telecom business going really well? There is a major player in the market today, and it has changed the game completely in terms of the pricing. So should we give it in the telecom industry? So that's more of industrial risk. While some of the industries might be booming at the same stage, some of the industries may not be doing that well. Concentration risk. So this is a type of risk which arises because you invest in specific portfolios. For example, you do not want to invest all of your money into one industry, or you do not want to invest or give all your money to one customer. So if there is, for example, one customer who comes in and who says that, you know what, you don't need to give money to hundreds and thousands of people and run big operation and branches. You just give money to me, and I will pay it back. And guess what? I will also give it give a better interest. But an organization may not want to do that. They would prefer to have their risk diversified, because they don't want to concentrate it. If there is one individual, and that individual, as we see these days, decides to leave the country, and does a lot of fraud, then the bank and the financial organization would also end up into the same state. So you do not want that to happen. So what you do is that you diversify, you reduce the concentration of the risk of the portfolios. So the other is the market risk. So credit risk was mainly about how we look at our own book from the credit perspective. Market risk is about that whatever portfolio that you're holding, whether it's a stock, or it's loans, or it's anything around those. How can that market movement change the value of those portfolios? So in a very basic term, if you have a few stocks, for example, if you have a stock of SBI personally, and the price of SBI stock changes in the market, then obviously your portfolio value is changing. So you have that market risk. Similarly, banks also have their portfolios. They have the banking portfolio. They have the other portfolios, but they all of these money have some level of market risk attracting to it. So interest rate risk. So what would happen is that if you may think that banks are only borrowing from the depositors, but in reality bank borrows actually from the market, and that cost of the funding may change, and that is called basically the interest rate risk. So while you giving the loan at X%, but at the same time the market rate would change, market rate might increase, and because you have to lend at a higher rate, but you gave the people home loan which is for probably 30 years, while when you're borrowing it, it's for a short term. So obviously there is an issue over there. So you have to plan and you have to hedge that kind of risk as well. Liquidity risk. What if all the depositor comes and they ask their money back, right? Then you have a liquidity problem. You have to immediately liquidate your portfolio, and you may not get the better rates. Currency risk. if you're dealing with multiple currencies, which most of the banks these days do, if you're walking in you're operating in different geographies, of course you have a FX risk as well. And hedging risk. So what happens is that when we have different types of risk, we tend to hedge the risk, but the perfect hedging is not possible. So we may buy an asset which may not be exactly opposite asset. So for example, if you'd want to hedge the stock portfolio with the fixed income portfolio with your deposits, it is possible that the rate of deposit might increase faster than the rate of the loans, or the other way around as well. So you may have a bit of hedging risk coming in. So this was mainly around the financial risk, and we'll take two examples, one of credit risk and market risk in coming slides. But let's talk about a little bit around the non-financial risk. So non-financial risk is faced by not just by the financial organization, but all organizations across the industry. Example of non-financial risk are operational risk. So anything arising out of operations is called operational risk. It could be related to people doing internal fraud, external fraud, policy systems, etc. Right? If the technology is not working, you have an operational risk. Strategic risk. The strategy that you have thought about might not work that well. Right? Funding risk. You don't get the funding for a particular project on a particular period of time. Political risk or geopolitical risk if you're operating in multiple geographies. So this is one of the core risks. You invested a lot of money in a particular region or a particular country, and suddenly the policies change over there, or government change there, and it became unfavorable for you. So you have to be very careful that what kind of assumptions you made before venturing into the business in that region. Legal risk. This is also something which we see these days. A lot of fines are getting imposed on the banks globally. So the legal cost increases, and the chance that you will get some kind of fine, and that will wipe up all the profits that you have made, or even bring you in losses. So non-financial risk can happen to any organization, but it's also very getting high focus these days in the banking industry or the financial industry in general. If there are any questions, feel free to type on the chat. Quickly, what are the different types of losses? So when we go and do a business, we know that some losses can happen, right? So if you are giving credit cards to a set of people, you know that some people will not pay back, right? So this is, and we should do everything in our powers to make sure that those people pay back, but still there would be some losses. Those are termed as expected losses. Unexpected losses, when you which you do not assumed at the beginning of time, but what regulators want you to do is to actually do some keep the money aside, especially for the banks. That's called capital. So you would keep that money aside so that if those losses happen, you can cover these losses. And the last one is a stress loss. These are like very if I can talk in the risk terms, very low frequency event and very high severity, something which happens in thousands of years, probably not thousands, probably 25 years or 100 years, but once it happens, it actually brings a lot of losses. I mean, typically financial crisis or stock market crisis that happens, those are termed into this, or some kind of natural disaster, big natural disaster happen that impacts the banks or insurance companies. You can call them as a stress losses. So bank has to put, regulators want you to put the capital for the unexpected losses. Expected losses, you have something called provisions which you have to maintain, so that if and you have to price your product accordingly so that this loss can be covered with that. And of course this is something which you cannot plan, but there is a lot of other type of analytics that happens to calculate this. So where risk fits in all of this, right? So how do we do analytics, and what do we do really, right? So in a very basic terms, and I wouldn't spend much time on this slide, but all of these businesses or the business units you have, they actually they create a lot of data, and that data is used by the for the risk management. So the analytics that we will talk about in a while would actually use a lot of this data and use that for the decision making. And of course there is a regular governance around it. There is a huge amount of measurement and reporting around it, as well as different kind of technique that get used to calculate this risk and enable the risk managers to make the better decisions. Data and analytics as enabler of risk management, like I mentioned, the decision that risk manager is going to make requires a lot of thinking through and a lot of data. And with the advent of big data, the techniques, the computing power, earlier it was, we had the computers were relatively slow, but now we can do much faster calculations, um, and a lot of advanced analytics that has enabled organizations to provide a lot of valuable insight from the data, which was earlier not that possible, or sometimes we completely relied on the gut feeling or the experience of the managers. But now that is all possible through the data, and it has become much advanced than what it used to be. To get an accurate picture of risk, your risk analytics solution must aggregate and analyze both internal and external data. So we're not talking of only internal data, we're talking of external information as well. And we'll take one example in a little while. But you can think about that, when your organization is losing money, how can you learn from the other organization? What other things they can do? um, Tracking and analyzing risk factors in real time provide huge benefit, because you know immediately when the anomalies are occur. So we are talking about early warning systems now, which can actually come up and say that these are the potential places that problem can happen, and we should immediately go and do something around it to mitigate that risk. Again, this is based on the risk appetite of the individual. It is again not that you will go and eliminate all the risk, or try to do management of all the risks that exist. You will actually look at the risks which are critical and or the key risk, and those are the risks you will go and try to manage using the data or using analytics or any kind of governance methodologies. So there are two cases that we have today. One is around the credit risk and using how we use the data in the credit risk area, and the other one is the market risk. So talking about the credit risk, right? So we discussed earlier that um, when you're giving the money to a lender, to the borrower, when as a lender, when you give the money to the borrower, there's a chance that the person will not pay back the money, right? Or he may not pay back, or he or she may not pay back the money in entirety. They may not pay back the principal, or they may not pay back the interest, any of those things. So the chance that person doesn't pay back full or partial is called the credit risk, right? Now when banks issue the credit, they would like to issue the credit to the people who pay back, right? They would not want to give the credit to the people whom they know that they will not pay back. And when we say payback, is sometimes these days we think about people will not pay back when they're willful defaulters. No, it's not like that. There is also situations that people are not able to pay back, right? They have a lower salary, they take the loan, but they cannot pay back the something that happens to them, or they took the loan more than they could, right? We talk about a lot about responsible lending these days. So if we have to find out the credit worthiness, it is similar to think about it in a way when you lend the money to a friend, or a friend's friends, or friend's friend, right? Somebody who is in the chain whom you know directly or indirectly, and you lend the money. And if that person has a history of not returning, you wouldn't lend the money, or you would lend the money by in some other manner, and we'll talk about that in a little while. So there are different kind of data exists that when we try to evaluate a customer. So if you simply think about it, you go to when you apply for a credit card or a loan, you go to a bank, you take a form, and you fill a lot of information there. And now you can relate this information, what is present on the slide here. So you fill information about your financials, your personal information, you things like age, employment status, income, your residential status. Sometimes people even ask that how many cars you have. They're just trying to find out that how much money you have. They also talk a lot about that how much loans you have. What is a prior loan? Can you show your prior account balance? There is also, they get something called credit history, which is extracted from credit bureau. This is an external data, right, maintained centrally. It tells us that what kind of in the past, when we took the loan, whether one paid back or not. So what was the number and the frequency of the past loans? What was the delinquency? Did that person did not pay for a month, or did not pay at all, or did not pay for six months? Any of that information. Then you have the behavioral data, you have the spending pattern, you have the repayment pattern. This is your internal data, right? Because most of the times you're lending to your internal customer, so a customer who has some level of business with. So if we just take a very simple simple analysis, and we only consider there are three parameters, right? You have education, the people who are, you know the education of your customers or the people who are applying for the loan. You know the income, and you know the age, right? Now if we plot the data, we can quickly form that, there are we can form clusters, right? So if you see, there are people who are, high income or moderate high income with low moderate high education and low moderate income, right? Or let's think about this one. So high income but low education. Any guesses who this group could be? High income, low education, right? Probably businessmen or politicians, like rightly said. So similarly, the other group, which is like low moderate education or low education and low income. These are our workers or drivers or the blue collared engineers, etc. Right? Um, then low this is our young population, right? They have the lower income as well as they're very young. There could be people who are higher income, higher education but low income as well, right? Which could be the fresh college graduates coming from our top premier institutes. So you have different groups here. Now just think about it. Would each group behave differently, or would it behave in the same way? So when we give the loan to a particular group of people, or a particular person from a group, would that person exhibit the similar characteristics to against all of those people? Probably no. Different groups behave in a different way. So this actually tells you that what kind of products you should have, what kind of risk methodology you should have for them. um, Main importantly, I mean, I think this actually draws that, your customers are segmented, and this, you can do a simple cluster analysis to get to this number. Also, when you want to actually find out that what is the credit worthiness of my customer, you want to analyze the past data, right? And one of the this is called statistical modeling, and this is what is the main part of the data science. So what you do is that you actually look at your behavior of the prior customers, what are the behaviors which differentiates the people who could default versus the people who don't default, the people who will pay back. And you take those characteristics and think about that, and you model those characteristics. You get the values, there's a mathematics around it. You calculate those, and then when the model is ready, and you know that, okay, now my model can differentiate between the performers, non-performers, defaulters, non-defaulters. Then when a new person walks in, as soon as the credit person actually enters the data, he would be able to see that what is my score, right? And based on the score, you can say that whether the person should be given the loan or not. So if I just go back, what is the modeling step here, and I'm just keeping it very high level. You do a lot of exploratory data analysis. We try to analyze information beforehand. We try to see that, let's analyze each groups and see that what different characteristics they have. Let's do it in a very simple manner. You look at the sum of the values or the mean of the values, and see that how groups are different. Then you look at the you do have to do a lot of data quality. You have to you spend a lot of time here, prepare the data for the modeling. If this step is not done properly, then you have an issue, because your model won't be correct. Then you analyze and transform variable. You do random samplings. You do not want to build your model on entire data. You want to take up a small subset of data, build the model, and see on the other subset of the data if model is performing well or not. Then you validate the model, like I said, on the test data, and you calculate the risk. And of course, you have to document the methodology, because your bank senior management or your regulators might be interested in terms of what models you have built. Also, if you see, this technique that we use here is called logistic regression, and it's one of the technique used for different in a situation when we have parameters and we want to differentiate between good people and bad people, or good characteristic and bad characteristics. Like I said, when you actually look at it, you start looking at the different scores. So when you do the outcomes, you look at, okay, these are the scores. I know that among if there are the X number of people who come in, for example, 170 came in, out of these 170, a few people are defaulters, so I should not give the loan to them. Or even if I'm going the loan, in some cases, I will actually go and price the loan bit higher. So the people who do not have a proper credit history, if they go to the bank, they have to take the loan at a very high rate of interest, or they may not get the loan there, but some other people will give it high rate of interest because they want to price the loan. They know that the people who are coming to them are not that credit worthy, so let me give it a little bit more costly. So they will charge a high rate of interest. If you go, the rate of interest in the market actually can go up to 35-36%. And that's surprising that some people have to take the loan at that rate of interest only because they don't have the proper information, or bank cannot model their characteristics. um, so this is the outcome. Any questions on this before we move to the next example? Okay, I'll yeah. So I mentioned about that when we try to do this kind of models, we try to look at what kind of products we are building for. So for example, when you are building for the personal loans, um, then you would actually there is no collateral, right? So in the home loan, at least there is a home. So in case if the person does not pay back, bank has the authority to take up the house and sell the house. But and which actually happens, some of the situations, this is unfortunate, but it happens. Banks have to actually go and take up the houses from the individuals and sell it and take the proceed as the rest of the amount. But in the personal loans, there's no collateral, and that is exactly the reason why the personal loans rate of interest is higher. So there's a pricing of loan in there. But also, if you really look at it, if you want crores of loan, then you can easily get it as a home loan, or at least a few tens of lakhs. But if you want a personal loan, obviously you can get a lesser than the home loan. So because the risk is high, the amount band would be leading to willing to put forward would be much lesser. And this is where the risk appetite comes in. When there is a collateral there, then the chance of loss is low and risk is low, so you tend to give more loan, while in the other way around, you tend to actually give less loan. But because the business has to happen, you still want to do the personal loans. Okay, we'll go to the next example. So this is an example about the market risk, and not so much around the banking scenario, but it's I've taken the example from the investment industry. So you have the Bitcoin these days, or cryptocurrency these days, and there are two ways you can, and this is a very good example, because the previous example we saw, when we had a factors of different models or decisions which could drive that decision, right? So for example, if the age, income, and education were the three factors when we were building up the model, which could define that yes, the person will pay back the money or not. And in real scenario, there will be hundreds of such variables, but we took the example of three. Now what if you don't have those? So there is another type of modeling that you do, which is based on your current and past record only, and which is mainly used in the investment industry, in the equities, even in the fixed income instruments. The example that we have taken over here is the example of Bitcoin, um, or a cryptocurrency. So what happens over there is that you do not know well, there is another type of model where you know that you assume that what kind of factors can actually change the price of Bitcoin. But what if we don't know all of that, and we do only technical analysis, which is we only take up the past values, and we see that if the past values can help us to see if we can predict the higher value. We try to find out the trends within the past value. So even in the case of stocks, if you have invested in stocks, you would see that the price of a stock has, always we talk about that this is a trend. We draw the line and we say that, okay, the stock will be within this range, or Nifty will be in this range only. That is all mostly coming from the technical analysis. The fundamental analysis is when you look at the parameters the factors which could influence the price of a particular company. And sometimes, people give more weightage to the technical analysis, because not everybody who is investing into the system is looking at the fundamental analysis. So this one is actually looking at how we can take up the prior price of the Bitcoin, and you can apply this to any other products um, like stocks, etc. So how do we take the prior price of the Bitcoin, and how we model, how we forecast the future price. And why would we want to forecast the future price? Because you want that, if I'm making an investment, can I make an informed decision, can I make a better decision? And we're talking of millions and millions or billions of dollars getting invested every moment around the cryptocurrency or any of those instruments. So over here, what we have is the data input as minute to minute updates of open, high, low, close, and volume of the Bitcoin, and indicated currency and weighted Bitcoin price. We use two techniques here. One is the neural network, and I'll just come to neural network. Another is the time series. So about the neural network. So neural network was designed as one of the another technique in data science. It is also called deep learning. And it was designed based on how the human brain functions, the brain neurons in the brain function. Technically, it's a model which combines a lot of nodes, and the information is passed to predict a particular decision. I mean, we can go in a lot of technical, but there's a more simplified manner I can explain it. That you have a different factors, and these factors actually take up a particular layers, and the end of the neural network you get the output. Time series is again taking the similar kind of data, the past data of like we mentioned, open, high, close, the volumes, even prices, and then predicting that what could be the trend. Are there cyclic trend? Are there any kind of, at a particular situation it goes up, in a particular time of the day, particular month, it goes up, because of whatsoever reason. We don't care about the reason in this model. What we care about is that, can we capture the trend, and is there a trend which indicates that that trend will be repeated in future? So how do we model that trend and get the output? So two techniques used in this particular test case to predict the market price. um, so this is the example of the neural network. This is how the neural network looks like, if you are interested. And neural network these days are used for a lot of things, especially identification of images. Example of Facebook or Tinder or any of those. There's a huge amount of deep learning that goes into it. It's one of the buzzword these days. So this is the prediction by the RNN. This is called recurrent neural network, or one part of artificial neural network. It's also called artificial intelligence. So it basically, you can see that it was able to predict the trends very, very closely. And this is an example of how powerful technical analysis, or just the past analysis without knowing any factors, can be powerful. So it has almost exactly predicted. We use ARIMA, which is the time series methodology. It's called autoregressive integrated moving average. It's another advanced time series method which is used for forecasting the trends. And if we see that the time series also has done really great job in predicting it. It has not predicted trends in some situations, but the prices have come very, very close. And if you look at the months as well, it was able to model. Obviously, this time series is very powerful. So what it does is also that it takes up the recency of information. It gives more weightage to the closer information. Using a ARIMA model, which was trained on around 70 data points, an average accuracy of 75 to 80% was achieved. So, and if you can make a even better model based on the data and based on your techniques you use, and using the RNN model, an accuracy of 95% was achieved, which means that in this case, the RNN was much, much powerful. And you can combine the two and get the result. You can get even better results. And obviously, why we are interested in this? Because this can help us to predict the price, and organizations can make a lot of investment, or even individuals or private equity funds can make the example. So this example comes actually from private equity. Any questions on this? So the interesting part of this these two example was also that though one talks about the market risk, one talks about the credit risk, another talks about the market risk, but also that the different way of calculation or the modeling is used in these techniques. One, like I mentioned, one was around using the data or data science to predict the credit worthiness of the customer, while the second one, and that was based on the number of factors or the individual customer has the data we have about the customer, while this one was more around how we just have the data of this variable itself and how we predict it, right? There are different kind of techniques within the data science that is applied in this area. There are huge application in the credit area. There's huge application market risk. Similarly, there's a huge application in the fraud area. And there are different kind of tools that people use. I mean, these days there's a flurry of your open source tools as well. So one of the common tool is, or the two of the common tool these days are R and Python, which we use in our models frequently. Traditionally, the tools that were used were more like SPSS, SAS, in this area. So recapping, so we discussed about what is risk. We also discussed about how to measure risk and what are the different controls, and we looked at talking about a little bit more around the control now. So you can have a control, but every control comes with a cost. So for example, you can say that I'm running a business and I will insure the business completely, right? And that insurance may have a price. In some situations, we decide to accept a risk. So it's your decision that either you want to accept the risk or um, you want to just mitigate that risk or reduce that risk. So in some situations, when we see that we cannot, it's too expensive to actually reduce the risk after a particular level, then you tend to accept that risk. Similarly, example, if is there a way to eliminate the complete risk? There is none. So the only way you can really eliminate the complete risk is by not doing that work itself or that business itself. So every business will have its own risk, and risk keeps on changing as well. So it's very important that we're using both qualitative and quantitative techniques to measure the risk. We also discussed about banking as a business, how it operates at a basic level. We also discussed about different types of risk in banking. We focus mainly around the financial as well as non-financial risk. We also discussed that how non-financial risk these days are becoming more prominent, and we may have a lot of losses or a lot of fines just because of one mistake or two mistakes that can happen within the operational risk area, or from the legal side. We also discussed about the geopolitical risk, which can arise because you're operating in multiple geographies. We took two examples about credit risk and market risk. We also discussed that in terms of how data analytics can boost the risk management. In the past, risk management was mainly done through the knowledge of people. The people who were experienced, they would say that, okay, let's do this, or let's not do this, or let's do it this way. But now you have the huge amount of data analytics being used in the space. The data science is completely changing the industry. In fact, we talk about that in some time there would be more weightage on the people who have the data science skills than the people who have the risk management skills. And over a period of time, you would see that the functions, even today, I mean, the functions of risk management, there's a huge amount of data analytics people rather than just having a simple risk management people or risk managers there. There would be two risk managers and there would be at least 10 data scientists or data analysts over there, and different kind of data analysis, of course. And yeah, that's we looked at the credit and market risk. So we have almost reached to the end of the session. I will open the floor for questions. As I mentioned earlier, use the chat to write the questions there. So one of the question is that how can I build up the skills around the risk management, and what is required to get into that area. So risk management is relatively a new area, and though I mean it has been there for quite some time, but if you look at it, it's a relatively new area, and there are a lot of new activities that's happening. Also, the data science industry is changing. So if you are planning to get into risk management or get into the analytics in general, this is the right time, because you have the huge amount of the data coming in. The computation power, like I mentioned, has increased. Plus, also there's a huge amount of jobs across every industry, not just banking or the insurance or finance industry, but across all the industries. And if you are interested to solve or come across learn business faster, the data is the best place to start. The amount of learning that you can have in a year is phenomenal as compared to any of the other roles that you would do in the other areas in the technology or operations. So that's one of the benefit that you get as when you are working as a data analyst or a data scientist. Of course, there's a lot of work and hard work that needs to happen, and a lot of things need to be learned. But as the technology is evolving, everybody is at the same page. So you know the people who are having a lot of experience in the industry, they also have to learn the same thing which you have to learn. So it's the best time to start. Any other question? Okay, I think we are almost end of the time as well. And since there are no more questions, I'd like to say thank you to all of you and all the very best for the future. If there are any more questions, feel free to reply to the email that you might have got as part of this invitation, or you can type me on LinkedIn as well. Thank you.